A very good afternoon, everyone. As we all know that financial reporting is an important tool in the hands of an entity. It contains vital information about an entity's health. With this, I would like to welcome all the participants in today's series of webinar on excellence in financial reporting, lessons learned, best practices, and commonly found errors, especially in banking sector. We have amongst us the presence of Dynamic Chairman of Research Committee, CA Dr. Anuj Goel, sir. Vice Chairman Research Committee, CA Kotha S. Srinivasan. And before going forward, I would like to share a brief introduction about CA Kotha S. Srinivas, Vice Chairman Research Committee. CA Kotha S. Srinivas is a graduate from Bangalore University and a fellow member of the Institute of Chartered Accountants of India and Institute of Cost and Works Accountant of India. He has served the institute for over a decade of two decades in various capacities. As a member of SIRC, he has brought in many initiatives, which includes conducting annual regional residential courses, digital projects for SIRC, etc. Now, I would like to request CA Kotha S. Srinivasa to please address the participants.
And Nehaji, we are having Kotha S. Srinivas sir, our Honorable Vice Chairman of the Research Committee, very prominent Central Council member from the southern part of the country. And in addition to that, of course, we are having very special guest today. We are having Advocate Vishnu Sharma ji, who is the member Bar Council of Delhi, has served Bar Council of Delhi as the secretary, as co-chairman. And we are having our Honorable Chairman of the Raipur branch, Mr. Gulani. And of course, we are having Ankit Maheshwari ji, very prominent resource person, and Kuldeep Kothari ji. May I request Kotha S. Srinivas sir first for his words of wisdom. Over to CA Kotha S. Srinivas.
Thank you, Chairman. Good afternoon to each and every one of you who have participated in this web series of continuously we are talking about how to do this financial reporting. Let me welcome on behalf of Research Committee the speakers for the day, C. Ankit Maheshwari sir and C. Kuldeep Kothari. Also, we have with us two gentlemen over there with our chairman, C. Anuj Kumar Goel, Advocate Sharma sir, and that's a member of
C. Ravi Gavlani ji, the chairman of the Raipur branch. We are having our ICI Awards for Excellence in Financial Reporting at Raipur. And of course, the chairman is amongst all of us. Yeah.
Welcome, Ravi sir, the chairman of Raipur branch. We are doing all this series of webcast where members will be knowing what all the important things that has to be taken care in case of financial reporting. Maybe at the year end we will have that awards, and you will be the hosting. You'll be hosting, all of us will be there. So thank you for hosting that particular thing. As members, as you are aware, this is a series of webinars. Initially we had for a manufacturing sector, and last meeting we had on service sector. Today, the gentlemen, the speakers will be speaking on this banking sector. What all the, how financial reporting has to be done, and what all the common errors that a person will see while doing this banking financials as such. I hope most of you would have recently concluded the bank branch audits, but of course we have this central statutory audits. Some of the central statutory audits have been done, and the general members in practice, maybe in some of the states, you may be doing this cooperative sector audits, that cooperative banks and cooperative sector audit. So this definitely will be very useful information that these people will share with you for the next 2 hours, where they will take you through the nuances of the banking sector, how to do this financial reporting, and what all the things, the common errors or mistakes that come across in finalizing or presenting the banking sector financial statements as such. Of course, as we know, financial sector is one of the major force or sector in a particular economy as such. India being a 5th largest economy, we need to have a great backing of the banking sector for taking the economy to the next level. But if you see, maybe 2 or 3 years back, when once we got this economic survey report, we came to know that none of the banks in India are in top 50. The top bank is SBI, which is after 50 in the world. But India is a fifth largest economy. So there are a lot of things that a banking sector has to do to see that that will give a fillip to the growth of this economy. In that regard, also as chartered accountants, we are there to support the banking sector, the RBI. We have been pursuing them to increase the or at least maintain the audit requirement. But as you are aware, that RBI is coming out with various circulars where it says the audit this thing should be reduced or it can be minimized as such. But as a council, continuous effort has been made. In fact, even yesterday we had a council meeting. Vociferously, our chairman Anuj Kumar Goyal was telling that this bank audit should not be stopped just like that, or it has to be continued so that we can help the banking sector and also the economy. So with these few opening remarks, once again, I welcome each and every one of you for this particular meeting. Also, I thank both Ankit Maheshwari sir and Kuldeep Kothari. Continuously, they are coming and sharing their expertise and knowledge with each and every one of us. I hope today also they will share their knowledge and it will be useful for all the participants as such. So over to the chairman, sir. Thank you, sir. Thanks for the opportunity.
Thank you, sir, for your.
Over to Neha. Yeah.
Thank you so much, sir. And we have amongst us CA Ravi Gwalani ji, Chairman of Raipur branch of CIRC of ICAI. I would request Ravi sir to please give a brief introduction of the dynamic chairman of the research committee.
थैंक यू नेहा। सर्वप्रथम मैं सबका धन्यवाद करूंगा, स्वागत भी करूंगा। हमारे बीच में जो अनुज गोयल जी बैठे हैं वो किसी परिचय के मोहताज नहीं है। आज अगर पूरे देश में बात निकलती है, वो चाहे नॉर्थ से निकले या वो चाहे साउथ से निकले या जहां से मैं आता हूं पावन धरा भारत देश की छत्तीसगढ़, तो वहां से निकले तो अनुज गोयल जी को हर व्यक्ति, वो चाहे स्टूडेंट हो या चाहे मेंबर हो, वो सीनियर हो वो या युवा हो, अनुज सर को हर कोई जानता है। ऐसे तो अनुज सर को किसी परिचय की जरूरत नहीं है, लेकिन एक परंपरा के अनुसार मैं उन सर का एक ब्रीफ इंट्रोडक्शन आप सबके बीच में पढ़ना चाहूंगा। CA Dr. Anuj Goyal is a practicing chartered accountant and the Central Council member of the Institute of Chartered Accountant of India. He has made significant contributions to the profession with his extraordinary tenure of 17 years in Central Council, 3 years in Regional Council, and 6 years in the branch, including chairman of CIRC and chairman of various ICAI central committees, members of the editorial board, and so on. He is self-motivated, enthusiastic, and hardworking person who has proved to be great source of motivation, especially for the youth. His contribution in the field research and development have always been remarkable. मैं इतना कहना चाहूंगा कि अनुज सर जिस भी कमिटी को लेते हैं, जो भी जवाबदारी उन्हें मिलती है, वो अमूमन देखा गया है कि कभी भी वो उनको कोई जवाबदारी मिली हो, वो शुरू से लेकर के अंत तक वो सारी कमिटीज में एक्स्ट्राऑर्डिनरी परफॉर्म होते हैं और सबसे आउटशाइन करके अनुज सर आते हैं। इन शब्दों के साथ मैं चेयरमैन अनुज गोयल सर को आमंत्रित करूंगा आपके उद्बोधन के लिए।
थैंक यू Thank you, Ravi Gwalani ji, our young and dynamic chairman of Raipur branch. Friends, we are having ICAI Award for Excellence in Financial Reporting since 1958, and this time we are going to have it at the capital of very, very dynamic state, Chhattisgarh, Raipur. And the chairman is Ravi Gwalani. I think we are having the best of the leader who is leading the profession at Raipur. We are having the presence of CA Kotha S. Srinivas sir, our very, very prominent vice chairman of the research committee, and Dr. Amit Agarwal ji is joining, who is the secretary of the research committee. Neha, tell Dr. Amit Agarwal ji to please be here. And I think we are trying our level best to see that how we can really do something very, very concrete for the cause of the profession through this research committee. And friends, we are having very, very prominent resource persons. C. Ankit Maheshwari ji from the Pink City, Jaipur. He has been the secretary of the Jaipur branch, one of the largest branch of the country. And we are having CA Kuldeep Kothari, very intelligent and resource persons, the rank holder in the company secretaries and the chartered accountant. And of course, we are having Dr. Amit Agarwal ji, who is the secretary of the research committee. And through research committee, we are trying our level best to see that how we can really do something very concrete for the cause of the profession, for the cause of the nation. And this ICI Award for Excellence in Financial Reporting, as since last more than 65 years, it is around 70 years that we are having this ICI Award for Excellence in Financial Reporting, 65 years. We made it a point, Dr. Amit Agarwal ji initiated that thing, that how we can have the series of webinars to handle the chartered accountants, whether they are in practice, whether as an auditor they are doing the services as an auditor, or whether they are in industry, because practically the financial statements are the baby of the chartered accountants who are in industry. So what are the lessons learned, what are the best practices and the commonly found errors while our technical reviewers had technical reviewers go through the nominations which we do get while going for the review of the financial statements for the purpose of finding the best presented accounts for the purpose of that ICI Award for Excellence in Financial Reporting. So in this series today, we are going to discuss the banking sector, very important sector, and number of chartered accountants are there. I think, Kotha sir, we must be having more than 25,000 chartered accountants directly working with the banking sector in our country. And in addition to that, I think each and every practicing chartered accountant in one way or another is contributing as far as the banking sector is concerned. So banking sector is the backbone of the economy. If we are going to 5 trillion economy very soon, I think great contribution of the banking sector, whether these are the farmers, whether these are the small entrepreneurs, whether it is a micro and small enterprises, or whether it is Ambani's or Adani's. Without very powerful banking sector, it's very difficult to really do something very concrete in their respective fields. And today's webinar's purpose is to strengthen our awareness and abilities in the field of best reporting practices and to highlight common errors. Financial statements are a repository of quantitative and qualitative information that provides stakeholders with relevant information. Friends, you are very well aware that as far as this banking sector is concerned, banking industry is an integral part of the whole of the financial system, and it is the backbone of the global economies, contributing about 7.7% of the whole of the world's GDP. And however, the turmoil of the banking sector is in great tax these days. We have seen in the western part of the world. Fortunately in our country, barring very small thing which has happened with Yes Bank, but I think it is the strength of our country and our economy and the banking sector that ultimately you must be witnessing that our own chartered accountants handled it, the problem which was there in the Yes Bank, and now that bank is also contributing for the development of the economy and the country. And I will request our honorable speakers to see that how we can cover very important areas, whether it is SDFC integral report and how we can cover adoption of Ind AS in banking companies, which is going to be mandatory from 2025. So I think each and every chartered accountant which is there in banking sector, either as an officer, as a CFO, or as an auditor, I think we are supposed to be very careful that Ind AS now is going to be applicable from 2025. So how is the preparedness of that? And thrust on the sustainability should be there, and FRRB key observations and banking companies. I will request Ankit ji particularly to cover those things, and compliance to Banking and Regulation Act is very, very important for each and every CFO which is there in the banking sector, because ultimately whatever are the guidelines of the regulator, Reserve Bank of India particularly, we are supposed to follow it in letter and spirit, and improving quality through the Institute of Chartered Accountants of India, as we are trying to handhold our honorable members, whether they are in industry or whether they are in practice. So how we can try to see that through research committee we can handhold and how we can help out our chartered accountants there. So without taking your further time, I once again welcome all our honorable members who are with us, not only from our country but outside country, because we are having the presence in each and every part of the world. Practically no economy of the world can really go ahead unless and until there is a very, very active contribution of the members of the Institute of Chartered Accountants of India. We intend to have our ICI International Research Award at in the Gulf country, in all probabilities in Dubai. You are very well aware that the research committee, for the first time in the history of the accounting profession, in 2020 initiated this ICI International Research Award, and the president of the International Federation of Accountants, IFAC, was the chairman in the very first year, as well as second year, as well as third year of the jury for the ICI International Research Award. That shows the importance of the ICI International Research Award. So this time we are planning to have it, hold it in the Gulf countries. We are having very, very strong presence of the members of the Institute of Chartered Accountants of India in Gulf countries. Around 20,000 chartered accountants physically are there. So in true sense, we want to make this ICI International Research Award global. I'm really grateful to Secretary Dr. Amit Agrawalji for being very, very active to see that how we can really do something very, very concrete for the cause of the profession, and in turn for the cause of the nation through our research project scheme. Very, very important initiative we have taken through research project scheme. We are trying our level best to see that how we can really do something very, very concrete to see that how we can try to enhance the revenues of the central governments and state governments, and how we can try to minimize the leakages, if any, in the various activities of the central and state governments. We have handed over research projects to the various ministries, including Commerce Ministry. Our Honorable Chartered Accountant Piyush Goyal ji is the Honorable Minister, and through those research projects, we ultimately try to help out the government, and an MOU between India and Australia on the supply chain.
Yeah, trade agreement.
Trade agreement took place on the basis of our own research project, which was undertaken by our own chartered accountant, who is
faculty at Deccan University.
Who is the faculty at the Deccan University, Australia. So that shows how important this research committee is for the development of our country. So without taking your further time, I once again welcome all of you, and our Kotha Srinivas sir has come out with a vision that in this 75th year of the existence of the Institute of Chartered Accountants of India, on 1st July 2023, the 75th year will be beginning. We will be celebrating 75th Foundation Day, and how we can try to see that in this 75th year of our presence, of our existence, Institute of Chartered Accountants of India, through its research project committee, can come out with 75 researches. So we'll certainly try to see that how we can really do something very, very concrete in the field of the research. I once again welcome Ankit Maheshwari ji and Kuldeep Kothari ji, our honorable resource person, and of course Ravi Guvlani ji, our honorable chairman of Raipur branch. Thank you very much.
Thank you, sir, for the valuable insights. We have amongst us the eminent speakers, CA Ankit Maheshwari and CA Kuldeep Kothari ji. CA Ankit Maheshwari is a highly accomplished and dynamic chartered accountant with an exceptional track record of over 15 years of professional experience. And CA Kuldeep Kothari is a fellow member of Institute of Chartered Accountants of India, having expertise in the field of FR framework, ESG reporting advisory, direct and indirect taxation, litigations, etc. Now, I would like to request CA Kuldeep Kothari and CA Ankit Maheshwari to please start with today's session.
Thank you, Neha, for a warm introduction of myself and Kuldeep. My special thanks to CA Dr. Anuj Goyal ji. After a long time, I was saying before the webinar, we see him in Delhi. And with the peer review mandate and with research committees projects, I have never seen somebody working as hard as he works. He is truly inspirational. And sir, you inspire us. I think the way you set up the tone of the session, we justify it to maximum. But yes, it is a lot to look up to in this entire session. And we are blessed that you are here and you addressed all the audience here. We have the Vice Chairman of Research Committee, CS of Kotha Srinivasan, who is again a very dynamic Central Council member. And as Anuj sir rightly said, the vision he set up for the entire completion of 75 years makes us to feel that there is a lot of way which we have to cover. We have CA Dr. Amit Kumar Agarwal ji, the Secretary of Research Committee, and under whose, I would say, mentorship, guidance, I and Kuldeep ji have been, working around this entire process of figuring out the commonly found errors. And thank you, Amit sir, for giving us this opportunity. We have my friend from Raipur. The last time we met was in Raipur only. CA Ravi Holani ji, the chairman of Raipur branch. And indeed, Ravi ji, we are looking up to these financial reporting awards in Raipur. I think it will be a great experience. Last I visited Varanasi, and with this, there's a lot of expectation when you look at Varanasi event. It was a great event, and when you look the working of Raipur branch, I am sure this year will be more. We'll do much better. I'll straight away begin with the session, and we have a session, a very important series today we are covering up with the banking sector. As Anuj sir set up the tone in this session, we'll try that we cover all these aspects, be it the aspect of integrated reporting, be it FRRB, be it the quality. We'll try that we justify whatever agendas our chairman has given to us to take it forward. I'll straight away share my screen. Neha, please check it out whether the screen is visible or not. And we also want that let us make this session very interactive. I and Kuldeep will be jointly speaking on this session. And Kuldeep ji has an exceptional track record as a head technical reviewer in the committee, also as somebody who is consulting one of the finest organizations in terms of financial reporting framework. And I'm sure both of us will be able to justify next 1.5 hours for you. So I'll straight away come, the aspects which Anuj touched upon. And the first aspect was the quality control mechanism. I have a humble request that let us make it interactive. We'll bother Neha a little for the answers which you give us. Keep on posting your questions between the session only, because it is such a vast coverage that in end it will be very difficult to take all questions at one go. So wherever you feel that there's confusion, there's a lag in what we are trying to communicate and what we are able to receive out of it, please come up with your points very specifically. We are very open to questions in between, and we want, it's a closely held group, very limited companies participating into it. Yes, we also have audience from the auditor side. The session entirely drafted in a way that even if you are from industry or be it you are from auditor, either side of the table, we'll try to justify maximum. So the session itself talks about lesson learned, commonly found errors, best practices. And to do this, Institute, already has an internal mechanism, which I want to bring on table about Institute's quality control mechanism. So Institute controls its quality through 4 very important boards. Can anybody tell me what are those boards? If we want to achieve the excellence in financial reporting, it is imperative that we understand how institute administers its quality. Then we will understand how the external agencies like SEBI or RBI administers, or even the NAFRA administers the quality of financial reporting. The idea of the session is to give you best suggestions. As a banking company, you can take a step ahead in preparing your financial statements and achieving the best possible practices. So my question to you is, we are talking about the internal mechanism, quality control mechanism of the institute. My question to you is, what are those boards, which administers the quality control of financial reporting in our country, the institute's boards? Any answers?
Not yet, NPC.
Are you able to access it?
Yes, not yet.
Okay. Any answers? I'm looking forward for some answers. If anybody can tell me what all 4 boards are there which administers the quality of the institute. Kuldeep ji, if you receive any answer, let me know, else I'll start going ahead with the session.
Yeah,
Right.
yeah,
So
I'll let you know.
We have 4 very important boards. The first board is the Quality Control Board. And with NAFRA coming in January 2019, now the Quality Control Board is administered by NFRA itself. Then we have an important board, which is the Financial Reporting and Review Board. As Chairman sir already deliberated that the commonly found errors of FRRB also needs to be discussed. But let us understand with what objective FRRB is formulated. When you look at the objective, you realize FRRB was formulated somewhere in July 2002 in 226th Council meeting of the Institute, with the aim to improve the compliance of technical standards as well as professional standards. That means your standard of auditing as well as accounting standard, or INDAS or IGAPs, I would say Indian General Accepted Accounting Principles of the listed companies or the companies in which public at large is listed. When we talk about public at large is listed, a banking company could be a listed company also. And even if it is not listed, it is one of those companies in which public at large is already vested. So FRRB handpicks 8, 9, 10 banks at one time, starts evaluating their financial statements, starts evaluating their annual reports, start finding the gaps of non-compliances specifically to India's accounting standards or standard of auditing. I can name, once FRRB is activated, it prepares a detailed report of non-compliances and creates the charge on the management also, and charges on the auditors also, and ask this question, give put up the points and ask this question as to why such non-compliances are found. To name a few, I can tell you, a small non-compliances और बहुत छोटी चीजें जो FRRB डिस्कस करता है या चार्ज क्रिएट करता है, they are not bigger issues, they are smaller issues. यहाँ पे ऐसा नहीं होता, you will not find that there is a material misstatement arising, but a non-compliances of a accounting standard is what FRRB looks into. So now, I was trying to tell you an example. So a small example wherein FRRB raised a point that cash flow statement is not rightly nomenclatured, which means that as per INDAS, this has to be statement of cash flows. Similarly, cash flows from operating, you see the dividend income or the rental income coming in cash flow from operating. For small auditors, sometimes, while we were signing the bank audits previously, now we digitally sign. The observations pertains to the balance sheets were signed digitally by writing SD flash. The methodology of valuation of inventories. So it handpicks each accounting standard or standard of auditing and puts allegation on the auditors or on or on the management side. And then the problem is that earlier, before 5-7 years, this report used to be an advisory kind of a report. But Kuldeep ji, over a period of time, we see 102 FRRB reports in last year, and we see more than 60 of them going for a disciplinary action. Also, those bankers who are from industry, I would want to highlight a very important change in our revised code of conduct, which talks about the no-CLAR change, non-compliance of other laws and regulation. So not necessarily that if you are a banker, you have to just comply to a banking regulation, but any other regulation which is applicable to your bank is also needs to be complied, even you are an employee to the bank. The change with this no-CLAR provision is we already had such kind of a provision in Karo, in which, if you are an auditor, you have to see the non-compliances of other laws and regulations. But with respect to the chartered accountants or professional accountants who are in industry, they have to understand this change, that this is applicable to them also. In October 2022, Institute deliberated, because we are a member to IFAC and International Ethical Standard Board. And when Institute started deliberating, then they put this applicability on the senior management of the banks or the corporates. To understand this further, there still needs to come out what category or what designation will be considered as a senior management. Then we have the third board is the peer review board. And when we talk about the peer review board, it is a board which is, where we are internally regulating things. And when you understand from that point of view, I would say one thing, that Institute, to enhance the quality, took a brilliant mandate to all those auditors who are here, auditing for banks who are 5 and more partner firms. I would want to reiterate that it is necessary that you get your peer review by 31st July. So that is the last deadline. Institute took this mandate in last year. And when Institute took this mandate, it was like the cutoff date was 1st April, but because our bank audits were slightly jeopardized and people were not, the capacity which Institute intended to build was not, was not created. So that's the last extension that we get. So Kuldeep ji, I would want to highlight for all those bank auditors, please get yourself peer reviewed, because if you're doing a bank audit and you are a 5-partner firm, it is necessary to, since you're performing an assurance function, it is necessary that you get yourself peer reviewed. Also, to all the bankers who are appointing, whose auditors are appointed by RBI, an additional check needs to be there, in which you have to see whether the appointment which RBI has made is in compliance with the direction which I am telling you of the peer review. That means if a chartered accountant firm which is not peer reviewed has been appointed by bank, then it would be an incorrect appointment of auditor or violation of norms. For listed banks, naturally, SEBI took this mandate way back in 2010. And then we have the Tax Audit and Quality Review Board. I wanted to discuss this board because all the special audits which RBI undertakes through this board only, the Tax Audit and Quality Review Board. And not only RBI, but even the SEBI, CBDT, CBIC. And interestingly, Institute is so keen about building its capacity that on all 4 boards, they have vacancies for technical reviewers. So all chartered accountants who are in practice can be a part of this board and start functioning accordingly. And you will find, if you go back to a mail, say 15-20 days back, you will find there is a vacancy for QR technical review of quality review board. The fees paid for a quality review is also extremely good. So it is like 1,25,000 for per review which you do in quality review. And similarly for Tax Audit and Quality Review Board and FRRB. So look forward for such kind of opportunities. That would be one suggestion. But most importantly, let us understand the mechanism. Now, when we move ahead, Kuldeep ji, I would want to focus on FRRB's, key observation. And when I focus on FRRB's key observation, I'll just take a break, Kuldeep ji. 1 minute.
Sure. So basically, what Ankit ji was trying to tell and what our Honorable Vice Chairman has said in the beginning, that as per the economic surveys report, SBI, the largest bank, was after the top 50 banks list in that particular survey. So as present, we are the 5th largest economy of the world, but none of our banks are featuring in the top 50 list. And as said by our Honorable Chairman, Dr. Anuj Goyal sir, that banks and the banking sector is the backbone of this economy. I would like to tell you a very unique fact that in the present year, that is financial year 22-23, the total profits of the PSU banks has crossed rupees 1 lakh crore mark. So Ankit ji, when we see this sector as the backbone of the economy, from the other perspective, that how it is contributing to the economy is also very huge, and the importance of all these boards which the institute has constituted, and continuously we are working to monitor the quality of the reporting of various sectors, be it a manufacturing service sector or specifically regulated sectors like banks and insurance. So over to you, Ankit ji. So
Right.
we can
So
start
the
with
idea is Kuldeep ji, that we both have and to all the participants here, we both have tried to analyze FRRB reports. We'll first come out with the commonly found errors as per Financial Reporting and Review Board, and we will also try to highlight certain points which we as head technical reviewers or technical reviewers in the research committee, while evaluating banking companies, find these errors. So now we are going on the technical side of it, and when we look at FRRB's commonly found errors or wrongly reported practices, I think this is something where everybody needs to pay a lot of attention. So the first pitfall, or I would say the first point, pertains to the disclosure of schedule of reserves and surplus, and that is not presented in line with the Banking Regulation Act. The Banking Regulation Act prescribes that you present it with the opening balances of all the reserves, all the various kind of reserves which banking companies maintain, and any additions, minus deductions, and the closing balance. In the smaller banks, I'm not talking about the largest banks, but in the smaller banks, FRRB found this as a commonly found error, where these banks are just disclosing their closing balance. It was also noted from the schedule of reserves and surplus that this is not in lines with the Banking Regulation Act, and thus violating this entire act. Kuldeep ji, if you want to add something into this, and
this is Ankit ji, this is particularly regarding the Banking Regulation Act. So as we all are aware that insurance and banking sector are one of the few sectors which are specifically regulated by different regulations other than the normal sectors. So as per the third schedule of Banking Regulation Act and the latest Master Circular RBI dated 30th August 2021, RBI has republished the draft of the financial statement, the way in which they are to be presented, and this was the prime error which was found in, as you rightly said, not in the bigger banks but in the small banks. This kind of presentational error was there. The second error, Ankit ji, pertains to schedule of investment. So as we all are aware that in the insurance sector as well as the banking sector, there are two type of investments which is made. One is in the approved of government securities as per the Banking Regulation Act, and the other is on other sort of securities. So if you have any sort of investment as a bank in other securities such as mutual fund or debt instruments, and the amount is material in context of the total investments of the particular bank, then you need to specify the type of investments, the type of instrument that you are investing into. And this was one of the commonly, I would not say, but in the few banks, this was the error which was seen while reviewing the financial statement. And I think these sort of errors be it a presentational type of errors, but they should not be there, because being a specifically regulated sector, there are severe penalties when diversify or diverge yourself from the prescribed schedules of Banking Regulation Act. So if you can,
Kuldeep, so you intend to say in this that in others, if it is a material investment which your banking company has made, so this needs to be specified. You just can't put up a consolidated figure of others and put your investments into it. That is what the intent is, right?
yes, type of investment is to be mentioned.
Okay. Can we come on the next point, Kuldeep?
Yeah, sure. It is also this error also pertain to, or this observation also pertain to the schedule 4 of the specimen of the financial statement which RBI has published. So this particular schedule, talks about borrowings of a banking company or a bank. So the specified format is that you put in the total borrowings, which then segregate it into borrowings from RBI or other banks, other institutions and agencies. And if you have any sort of borrowings which you have procured from outside of India, then it is to be mentioned also. Below that, there is a specific disclosure which is required to be made with respect to the fact that out of total borrowing, say you have borrowing of 1,000 crores or 2,000 crores, how many, what amount of borrowing is secured. So while observing the financial statement, it has been found that few of the banking companies have not mentioned it, and RBI specifically says, if you are presenting the financial statement in the format of the schedule as specified by Banking Regulation Act, if there are no secured borrowings out of the above borrowing which you are presenting in your annual report of financial statement, you need to mention it there. You need to mention it that there is no amount which is secured. So this is also a presentational error, but it may attract penal provisions from RBI. So Ankit, if you can deliberate on the next error, which is also
definitely. I think this is a top error, I would say, out of 4. So my question to all the bankers here and who have been auditing the bank: how does bank present their segment reporting? Under what segment you would report as per AS 17? How will you categorize these segments? Can anybody tell me the answers with respect to the business segments also and with respect to the geographical segments also? Because a lot of banks were found to present it as a whole, doing an entire non-compliance of AS 17. So my question to our learned audience is, as a banking company, how do you categorize your segments? Do we have any answers to this? Kuldeep ji, we'll wait for a minute for the answers, and
sure.
then we progress. My question, I am repeating my question again. How do you categorize your business or operating segment if you are a banking company? And how do you categorize your geographical segment if you are a banking company in compliance with AS 17? Kuldeep, do we have any answers?
No answers yet, Ankit.
Okay. Did we had any answers to the previous question?
Not.
No. So I request everybody to be more participative into it. It will only enhance our learning and everything. So if you have to categorize the business segment, you will categorize it as a retail, you will categorize it as corporate, you will categorize it as investment, you will categorize it as wealth management. If you're dealing with insurance product also, you can categorize into insurance, into asset management. So a lot of banks were found to being deficient in one, appropriately categorizing this segment. Two, in some cases it was fine, no categorization or no segment reporting was done at all, resulting into non-compliance. And for geographical segment, so for geographical, most of the banks missed this miss this entire bifurcation of segment in terms of geographies. So in terms of geographies, the advisory from NAFRA, the advisory from NFRA, FRRB is very clear. And they say that a bank needs to categorize it into domestic and international operations. So your numbers coming from your domestic operations and international operations, they need to be in line and need to be in compliance with AS 17. So the problem, I hope we are able to deliberate on these 3-4 issues which FRRB highlighted. If you have any specific question pertaining to it, please come up and post your questions here. We still want that this session becomes an interactive session and we are able to hands-on solve your problems.
We had 2 answers.
Okay.
One was 3 answers to be precise. One was for that secured borrowings note. Kirti Shukla ji from CIRC has said whether refinance taken from SIDBI, NABARD, etc. to be considered as secured borrowings or unsecured borrowings. So I think they are to be considered in unsecured borrowings only, not in the secured borrowings. The second answer was from Mr. Kunal from WARC. He has mentioned that the banks define the segments into treasury, retail, corporate, and other banking operations. One answer was from Bandish Satra. Segments are categorized as per the RBI guidelines into corporate, retail, treasury, and others.
Fair enough. I think we got answers for bifurcation of business segments, and these answers are the most proximate answers. The only thing is the missing of geographical segment and only stating it as only one geography. The idea is that FRRB suggested that we can bifurcate it into domestic and international operations. Let us go ahead on the next part of it, right? And so this we talked about the internal mechanism. And now we are quickly discussing the external mechanism, which is being prescribed. We talked about few commonly errors which FRRB found, because the problem is that FRRB is looking in compliance with more with Ind AS. That is why you don't find too many observations from FRRB coming. However, we will try to discuss the reports of RBI and CAG even while the Ind AS were implemented on NBFCs and what kind of impact it had. But as of now, the top 4-5 observations of FRRB are discussed. Then we'll discuss the other sections of the report. So when we talk about the external mechanism, we have SEBI, we have Ministry of Corporate Affairs, we have RBI. We consider them as external mechanism. And if a banking company is a listed company, then it has to also comply to LODR guidelines. When we talk about compliance to LODR guidelines, and Kuldeep ji, I would want to bring this to the notice of the smaller companies also, or the smaller banking companies also. So the thrust, when we say excellence in financial reporting, the thrust is not only around the financial statements are in compliance with the Companies Act or the Banking Regulation Act, and the notes are in accordance with the accounting standards which are applicable in India, but also on the other portions of the report. So Kuldeep ji, one commonly found error, I would say on a macro level, we find is that a lot of being finance guys, being finance professionals, we are placing our thrust only on the financial part. In this entire session, we also want to cover the non-financial part. If you're a listed entity, then how do you present a chairman's statement or a director's report, or maybe your management discussion and analysis, the corporate governance report, your sustainability disclosure, and of course the financial part, which we will try, Kuldeep ji, if we can make our audience future ready for adoption of Ind AS, because Ind AS is coming, and this is the first time adoption, which will, I am sure, which will start from 1st April 2023 itself. Because when you start presenting your balance sheet from the period of 1st April 24 to 31st March 25, you have to present a corresponding balance sheet before it. So we will discuss that entire aspect But point is, as we understood the internal mechanism, let us try to understand the external mechanism of SEBI, of RBI, of Ministry of Corporate Affairs, and what kind of errors are found. One part. Two, we also need to understand a very important aspect, that when the institute's research committee talks about excellence in financial reporting, then they're just not talking about excellence in financial reporting on the financial statement part, but also on the other parts of your financial report. And that is why Anujji gave a thrust on integrated report of HDFC, or maybe the sustainability reports. If we are left with time, we will open those points. So when we talk about LOD regulations, Kuldeep, I want to come up with a very important advisory which NSE has issued on 15th March. The advisory talks about publishing. So we are talking about LODR compliance. This is applicable to the banks which are listed and the auditors of these listed banks. My question to my learned audience here is whether investor presentations are compulsory or not. If you are a listed entity, then are you mandatorily required to prepare a quarterly investor presentation? Question number one. Kuldeep ji, if you have any answers to this, I am very keen to hear this.
Not answers to this, but we have a question from Mohammad Sharif PK from Federal Bank, which will answer after you take up this LODR point.
Okay. So my question to you is: are we ready? Are we supposed to mandatorily prepare quarterly investor presentations? Any answers?
Not yet, but again a question from Mohammad Sharif ji. He is asking that on Ind AS, did RBI issue any circular? Are you referring the discussion paper on ECL? So let me answer this before you.
Covering in the later part of the session, Mohammed, we are covering this entire process of ECL and the RBI circular and the impact of Ind AS. Yes, we are referring to that entire section only, and we have detailed out in the presentation. Allow us 10 minutes to get to that slide. So simple question. Again, my question is very straight question. Are we mandatorily required to prepare investor presentation?
Not mandatory. We have answer from Bandish Satra, not mandatory. And he has the similar question which we will take up in the later part of the session related. Is there any circular issued by RBI regarding Ind AS implementation timelines?
Yes. We are definitely taking that up, sir. But let us first dissect this portion and then go on the recent circular of RBI. I think I am opening up with the advisory also, and I'll answer it also. So one, it is mandatory or not. So I think the answer is a very fair answer, because this is a lot of perception, Kuldeep ji, in the industry, where companies just upload their board reports and annual reports after the quarterly board meeting is held. The problem here is that these companies also needs to prepare a quarterly investor presentation if there is change in some significant events. Now, when we look at those significant events, Kuldeep ji, you will realize that in 9 out of 10 cases, rather I would say 10 out of 10 cases, LODR prescribes these events and there is a change. And that is why companies do this quarterly presentation activities, and companies have started doing it. When we see non-banking companies like Asian Paints, they not only make quarterly presentations, but Kuldeep, they do quarterly conferences, investor conferences. So as a banker, if you're supported by your shareholders, if you seek more support by your shareholders, yes, you should prepare investor presentation. Two, even though you will not find a blanket mandate from SEBI for preparing investor presentation, but SEBI provides for certain situations in which investor presentation will be there. I'll try opening up both the things. Also, my second question here to you is that if you are preparing an investor presentation, then how do you upload that investor presentation? Do you upload it with your financial statements and auditor's report, or do you upload it separately? And in case Kuldeep ji, I think it will be a great idea to now come up with that advisory which NSE issued on 15th March as to how do you upload your investor presentations and how do you upload your auditor's results.
Before we move on to that specific circular of NSE, we had two answers. One was from Mr. Kunal from Mumbai, that investor presentations and conference calls transcript is required under LODR. And
Perfect,
second
perfect.
was from Mr. Satyanarayan. No, but it is a regular practice.
Perfect. So I think we are able to dissect it. They have specified those conditions under which investor presentation needs to be made. And those conditions are such conditions that ultimately you will fall in that pitfall and you are required to make it. So it is always safe to make investor presentations, and LODR also prescribes it only. Also, it is about winning your investors' confidence. I like the answer where, Kuldeep ji, who talked about audio transcripts. What was the name of the member?
Not audio, but conference call transcript, Mr. Kunal.
Perfect. So the transcripts are of those conference calls, and Asian Paints is, again, I was giving an example, uploading your audio transcripts. There's a lot of change happening in corporate reporting domain. And that is, you move one step ahead. Today we see audio transcripts. I am telling you, we are in an era that in next 2-3 years, you will see video transcripts also, because these reports have gone so bulky with integrated reporting framework coming, with sustainability coming, and then entire CFS and SFS, coming up in one report. This has become bulky. So there will be some methodology where investor is able to access to these records more easily, and for which we should be geared up. As of now, I'll not go off track. Coming back on track, we were talking about quarterly and annual financial results. We were talking about the manner of uploading quarterly results. It was a major non-compliance seen by SEBI, seen by NSE, and that is why they have come up with an advisory. If you permit me, I'll share the advisory, Kuldeep ji, and then we deliberate on that entire advisory itself.
Perfectly fine. But before we move on to that advisory, I think we have a very spot on answer from Bandesh from Axis Bank. He has said that investor presentations has to be uploaded separately, not with the results.
Fantastic. Sir, fantastic answer. That is what NSE advisory is also. For other members, I am just taking a minute of yours and try to read that advisory on behalf of you. Just give me a minute. Kuldeep ji, in meantime, we can, you just start deliberating on another issue. I'm just figuring out.
So basically, one of our member has asked that whether there is any circular or timeline which has been given by RBI for implementation of Ind AS. So to take up this question in between, to those who have asked, RBI has not issued any sort of circular specifying the timelines under which the date on which Ind AS will be applicable, made applicable on the banks. But there is a talk in the government sector in the North Block that it is expected that 31st March 25 will be the probable date at which we expect that Ind AS will be made applicable. And for your information, you must be aware of the same, that since I think 2017-18, RBI has mandated it for the banks to submit half-yearly performa Ind AS financial statement on regular intervals, so to make them future ready, and to when the divergence takes place, it is not that painful for the banks or the banking institution to switch. Over to you, Ankit.
Right. So So I'll just read the crux of the circular. This is the circular which we were referring. I am reading the third paragraph. In this regard, I am highlighting it. In this regard, listed entities are required to note that PDF of outcome of board meeting held to consider and approve financial results must only include financial results, auditor's report and other statements as prescribed under Regulation 33 Part A, right, and related circular. If company wishes to disclose any other information, such as shareholders' letters in the presentation, be done as a separate announcement. Majority of the companies like Vedanta, you look at their quarterly reports, you will see their investor presentation and their auditor's report uploaded together. So please make sure that in order to enhance the practices or making it excellent, we don't we don't start doing the non-compliances. So that is one thing which I wanted to bring to the knowledge of our learned audience. If you have any question pertaining to this advisory, please feel free to ask.
Not yet. No
Okay.
questions.
So I'll just share back the screen, Kuldeep ji.
Yeah. So one of the questions of Mohammad Sharif ji was that, are we referring on the discussion paper on ECL? So Mohammad Sharif ji, we are not exactly referring to the discussion paper on ECL that RBI has published recently, and it is a talk of town also that very soon the provisioning norms which are being regulated as per the IX norms or the prudence norms are going to change, and the provisioning will shift to ECL. So you can take it as a what should I say? First step towards moving to Ind AS, because when you move to Indian accounting standards from the IGAP, you will find that the provisioning will be based on the ECL framework. Over to you.
We will discuss that also on a later part. So when you look at SEBI as a whole, so it is about the quarterly and annual presentation, and then you look at the financial statements, the notes, the advisory. One common thing, Kuldeep ji, which I found, while evaluating the annual reports of bank, is the reference of accounting standards. Since there's a limited reference to accounting standards which they are making. So even if you're a banking company, right, the relevant accounting standards are applicable to you. Exceptions are few, right? But so make sure, if you want to come out with an excellent practice, if you're writing accounting policy, if you're writing an accounting estimate, if you are writing a keynote, a key auditor's observation, right, or key issues pertaining to audit, make sure that key matters, make sure that the reference of relevant technical standard is given. That is again commonly found non-compliance. Then we have the other aspects of corporate, the other aspects of LODR. And Kuldeep ji, I would say a lot of penalties by SEBI are instigated not because of non-filing, but because of delay in providing information. So when I was discussing on the previous slide, so it is not only the LODR 2015 regulation, but it is also about the insiders trading regulation, the buyback of securities regulation, the ICDR regulation, right? All these needs to be complied. Yes, people complied, but the bankers complied, but somehow they are unable to upload the information on time. One more thing which I wanted to add, where SEBI is slapping a lot of circulars, is the related party transactions. And when we disclose these related party transactions, I think we should go back to our accounting standard and try to understand what exactly we have to disclose. Merely disclosing the name would not suffice. There are certain additional details which you have to furnish party-wise when we are disclosing the related party transaction. Naturally, the other reports, the corporate governance report, board's report, when we come on the later slide, what are the commonly found problems here, we will see that. But primarily, LODR sees, checks out the disclosure and reporting requirements. Then then the scrutiny and investigation comes and enforcement is done through SEBI. I would say, to our experience, to my experience, we realize this fact very well that a small non-compliance can can result into lot of bigger issues. So it basically starts from SEBI. With SEBI, when SEBI slaps a circular, they open up multiple fronts, and when multiple fronts are open up, your RBI gets activated, your SFIO gets activated, your enforcement directorate gets activated. But the first fault finding authority here is SEBI, and that is why I am insisting to all the listed banking agencies to make sure that their compliances are fairly done. So that was the cases which we were discussing about. So now I'll come on the overall financial reporting framework. When we look at the overall financial reporting framework, we have 5 very critical sections. And as Anuji was telling in the beginning, I'll try to open up with HDFC report itself, and we will discuss the integrated reporting framework also. So when we look at those 4-5 sections, the commonly found errors which we see from the non-financial part comes from the chairman's report or the director's report. As technical reviewers, there is a lot of weightage given to the chairman's message. A chairman message should also talk about the key observations which auditor has made. That should also be part to the director's report. Also, the plans for next 3, 4, 5 years, the vision of your bank, the vision, mission, plans, everything needs to be fairly documented. With regard to the director's report, we realized we were looking at a bank in the northern part of the country only, and we realized that the disclosure pertaining to their internal controls or their business continuity plan are also missing as a part of director's report. So in case if these things are in your category, I think there's a lot to think about, there's a lot to talk about. Then we have our management discussion and analysis section. As I was mentioning in the beginning also, that the segment reporting and everything needs to be done correctly. Your business segment, your business segment review, your financial review, your operational review, your overview has to come out well. The problem comes after the introduction of integrated reporting also, because when we talk about integrated reporting, there is a lot which we need to do in terms of integrated reporting, and we describe our capitals in integrated reporting. We do the material assessment. We also raise our risk and concerns. But the problem here is that a lot of companies get confused when they draft their MDA, thinking that they have already provided this information as a part of integrated reporting. My request to everyone here would be that let us understand this fact that one, integrated reporting is a voluntary adoption process. It is not done under any law. It is done by IIRC, we being a member of IFAC, and we adopted the international integrated reporting framework. So it can't be a replacement to MDA. The contents which you are putting in integrated reporting as a part of your annual report, try to cross-reference these contents. So either you cross-reference it or you add, you may come up with your risk, concerns, opportunities, threats, the prescribed format of SEBI for DA that can't be compromised. The third is the corporate governance report. And when we talk about the corporate governance report, we realize that we have to give the number of meetings the directors attended, how the lead independent director was appointed, how director's qualification and working was monitored. All this has become a very critical part. With a lot of corporate governance issues coming up, this report is looked by a lot of regulators. So I can give you an example. For example, if you have an independent director or a director in a public sector bank, and he's in some committee, maybe the nomination and remuneration committee or any committee, in that process, if he's not able to attend some substantial meetings, then as a part of disclosure, you need to also mention the reasons why these meetings were not attended by the director. If you are not able to appoint a lead independent director, you need to give the reasons why the lead independent director is not appointed. If a performance evaluation of directors is not being able to done, then how do you, again a disclosure. How do you, and as far as an excellent financial reporting practice, I would say this needs to be figured out. How do you quantify the experience of your directors? How do you relate it to the banking industry? How do you demonstrate it that those who are charged with governance are the most capable resources with the bank? And that needs to come out very well as a part of excellent reporting practices. Institute on Technical Review gives a lot of thrust on corporate governance report when evaluating the financial reporting framework for the awards which Anuj was talking about. Uh, Kuldeep ji, you have any other point to add up? Else the rest I will discuss in uh, the integrated reporting framework also. But my idea here to communicate our learned audience was we have to move one step ahead when we talk about excellent reporting practice and start focusing on the other areas also, including the integrated and sustainability, which I will separately discuss.
Before moving on to the financial disclosure section or other sections, can I take up a few questions which is
Sure,
related to the previously deliberated part? The first question is from Bandish Satra from Axis Bank. He is asking that from FRRB's point of view, there are only 4 majorly found non-compliances. What are the other points that they are taking into consideration while picking up the reports for evaluation or selection? So
Okay.
I think you would like to, you can add up.
Yes, yes. So not that, there were only 4 points which were raised by FRRB. There were few more points which were raised by FRRBs, but they were found in very limited banks. So there's a very limited data available with FRRB. Yes, that is something which is acceptable. And that is why I said that, when we go ahead with this presentation and we talk about more financial disclosures, we'll come up with NFRA suggestion also. We'll come up with the RBI regulation also. So you can be rest assured that there will be certain more errors which we will come up with.
The other part of his question was what are the points that are being taken care for selection of financials for excellence in financial reporting for banks?
So that is what I have been deliberating. I am saying the financial part is one thing. The other is, your preparation of your integrated report, your sustainability report holds a lot of marks, your corporate governance report, your management discussion and analysis, your chairman's report, director's report. All these things have due weightage besides the financial disclosure and the quantum of financial disclosure. I also mentioned one point in between. While we are technically reviewing these reports, how much reference did you give of a professional standard? Oh, sorry, a technical standard.
Technical standard.
What quality of disclosure we are able to give if we are, if we are preparing significant notes to account or accounting estimate, and how much it is in compliance with an accounting standard. That is something which is seen by the research committee. If you have any further questions, I am happy to answer that. But there is a lot of areas to work upon. Everything has a marks. I can give you example. For example, in lot of banks, Kuldeep ji, we found that value added statement was missing. So can you tell me, somebody who posted this question, in your report, I think it came from Axis Bank, right?
Axis Bank.
So you look into your value added statement, check it in compliance with, and so it has 6 marks. I'll give you more into detail. So this out of 100, 6 marks are given to this value added statement. Out of this 6 marks, 1 mark each for you mentioning whether how much you have contributed to equity, how much you have contributed to debt, how much you have contributed to national exchequer, how much you have contributed to your human resource. So all these things in a graphic format needs to come out well. Also, the visual aids are important. So once you miss a particular section, you lose a marks. For example, if you have not mentioned the risk and concerns, if you have not mentioned about your internal control system, if you have not mentioned about the enterprise risk management framework out of your MDA, everything constitutes a marks. So my request will be, yes, the financials are important, but pay a thrust on non-financial also. This year, if you are adopting a forward-looking practice, say you are adopting a practice of integrated reporting, then there is an additional marks to it. So all this checklist is very methodologically created. One, to every time an amendment is to be made in this checklist, this goes to the entire council and gets amended. And it's a forward-looking checklist. So I hope I'm able to answer things. Yes, we will cover the financial parts. Don't worry. We will cover the adoption of Ind AS, also the compliance of the Banking and Regulation Act. But that is something which I wanted to bring on table. Kuldeep ji, anything else?
No, there are no other questions. One question is from Mahadevan ji. He is from Federal Bank. The related party as per Ind AS 18, sorry, AS 18 and LOD is different. So Mahadev ji, I think you are right in stating that, but if you are a listed bank, since your bank is a listed bank, there are different regulations, SEBI LOD regulations which are being applicable, and you are required to upload the related party reports on half-yearly basis. This is in addition to what accounting standards as of now specifies. And while Ankit ji was saying that we need to put in a thrust on financial as well non-financial reporting, the reason here is that, see, banking and insurance being specifically regulated sector, you all must be very well aware of the Banking Regulation Act or the schedules and the errors per se in the financial statement of the big banks are not related to the schedule or the format which is prescribed by Banking Regulation Act. But when it comes to referring to the accounting standards in the accounting policies, or putting up a specific accounting policy, there are a few errors which we have seen. Ankit ji, if you can correlate, when we were deliberating before a board of a bank last week,
Right.
Specifically we found that the board was very well informed, but when we were analyzing that particular annual report, it was a mistake in few of the PSU banks, to be specific, that while specifying the revenue recognition policy for commission received from bank guarantees or letter of credit or locker rent, other than the government business, to be specific, they have mentioned that they are booking the revenue on the realization basis, whereas the private banks such as HDFC or the ICICI, they are booking it over the period of contract. So this was not in line of accounting standard. So what Bandish has asked in the beginning, that these are only 5 points, I would like to say that what FRRB looks into is that even though you are complying with Banking Regulation Act, because it will supersede in case of a banking company, if there is any sort of deviation from the accounting standard, it is also being looked upon by the FRRB. Over to you, Ankit.
Okay. So I think overall we tried to give a picture of the entire framework, covered few financial parts, tried to administer how the quality is monitored through various agencies, be it the institute and others. Now I'll move on because there was a lot of deliberation, and Kuldeep ji, we had a RBI circular also in I think in year 2018.
2017-18, in which they mandated the banks to submit pro forma Ind AS financial statement on half-yearly basis. So the banks are submitting the same to RBI since then.
So, but I think the idea of RBI is to gear up these banking companies, because there will be a lot of impact. The next few minutes goes on what kind of impact would be there when we look into when we look from the view of adoption of Ind AS in banking sector. For this, we have tried to benchmark the adoption of Ind AS in NBFCs and what kind of impact they had on their PATs, on their on their investments, on other things. So that is something which we will try to benchmark. So one thing, the basic difference between IGAP and I would say the Ind AS or IFRS framework is the adoption of fair value methodology. More than that, Kuldeep ji, you will agree to my point that the Ind AS and IFRS are balance sheet focused standards, and that is why a lot of thrust is given on preparation of balance sheet as per Ind AS, followed by following years maybe the income statements and the statement of cash flows or the statement of changes of equity notes and comparative information comes about. So the Ind AS in banking would be a tricky task. It will not be as easy as it was for the other concerns, and that is why we took that kind of a time. So I hope this snapshot makes it clear as to how we are approaching Ind AS.
I would like to
Right.
add something in this particular snapshot that we have shared. So while talking about adoption of Ind AS in banking sector, you all must be aware of Ind AS 101, which is the first time adoption for the entities who are adopting the Indian accounting standard for the first time. So, the basic difference between accounting standards, IGAP or the Ind AS is that, Ind AS is principle driven. The basic principle is substance over form. So it says that your accounting should reflect the intent of the transaction. So the focus is shifting from P&L to balance sheet. It says that P&L is basically the difference of your opening and closing balance sheets, and what is being stated in the balance sheet has to be correct and apt also. So meanwhile, when all the banking companies are preparing the financial statement, they are giving P&L, balance sheet, or cash flow statement. But like the snapshot was mentioning, statement of changes in equity solely will be a part of balance sheet as and when Ind AS will be made applicable. So coming on to Ind AS 101. Ind AS 101 is first time adoption. So there were many questions from the participants that whether there is a timeline or any sort of circular which has come up from RBI. But seeing the provisional ECL framework which RBI has issued in the previous year, it is giving us signals that the Ind AS implementation is not far in the banking sector. And Ind AS 101 will be applicable for the first year only, that is the year of adoption. So basically, when you move your financial statement from IGAP to Ind AS, so in that particular year, you need to require present your financial statement as such that from the very beginning you are applying you are preparing the financial statement as per Indian accounting standard. So say if you are Ind AS are being made applicable for the banks for the year ending 31st March 2025. So the opening date for you will be 1st April 23. So you will be preparing a comparative of say 23-24 and 24-25 will be the present year. So when you move on to Ind AS, as this we have all seen this 101 when the Ind AS were made applicable in the other companies, listed companies from 1st 2015 onwards. So it gives you few sort of exemptions and exceptions. Exemptions are of two types. One is mandatory exemption, which is say Ind AS 109 or Ind AS 10. And what we will be discussing are the optional exemptions, out of which I will discuss the first and then Ankit will take up the rest too. So say when we talk about implementing Ind AS, it says that you need to present your financial statement, restate your financial statement in such a way that from the very first day they are being prepared as per Indian accounting standards. So when you talk about Ind AS 16, that is property, plant, and equipment, if you don't have this exemption, you will be required to prepare the fair value of the particular asset, calculating it from the very date from which you have purchased or the last date of revaluation. But here in case of property, plant and equipment, in the simplified approach or in this particular exemption, it gives you an option that you can consider the carrying value as on your opening date as the fair value, and you can proceed with the remaining of the life, and you can depreciate the asset accordingly. So over to you, Ankit.
I think perfectly said. With regard to Ind AS 27, which talks about separate financial statements, and I think we should not always, when we read Ind AS 27, we should also read Ind AS 28 also along with that. And where while almost all bankings have associate subsidiaries or investments into their associates and subsidiaries, how do you disclose these investments and subsidiaries? The point one is, how do we prepare separate financial statements? Do we have an option not to adopt it? Yes, we do have an option that, for to begin with, we don't present separate and consolidated together. Two, in terms of Ind AS 103, where we talk about business combinations, a banking company may also choose not to apply it. So this is based on the precedent of NBFC only. Similarly, Ind AS 109, where we had the financial assets, right, which talks about classification of financial assets, financial liabilities, and our financial instruments, right. So there could be a case where we can choose to be materially, not following these Ind AS as we are adopting it for first time. Now let's look into the factors which are driving the changes in NBFCs, right, or NBFCs SPAT. These factors will also be there for you also, which would be, how do you value your employment benefits liabilities, or the recognition reversal of direct taxes, what kind of impact it has, how are we measuring the investment at fair value through profit and loss. As told in the beginning also, the entire concept of Ind AS is around fair value measurements. So when you talk about the first point where, we are saying that what will be the change in PAT. So you saw that you will realize that there shall be differences which shall be occurring on account of measurement of liability, which are towards post-employment benefits, right? In Ind AS, you see that actuarial gains and or losses are recognized and are taken under comprehensive income and directly to retained earnings. In Ind AS, you see them recognizing in P&L account, right? Where gains and losses are taken to comprehensive incomes. Similarly, Kuldeep ji, you want to add anything into it?
Yeah, sure, Ankit. As per Ind AS 19, which is for employee benefits. So when you see your present accounting structure under IGAP, and when you compare it with the Indian accounting standard, there is a very basic difference that towards the liabilities or the assets related to the post-employment benefits, such as gratuity per se or leave encashments, if you be to be specific. So what Ind AS does is Ind AS requires you to measure your liabilities as well as assets on actuarial valuation basis, and it says that while you are recognizing any sort of actual gain or loss on account of this particular measurement, you need to park it into other comprehensive income and take it into retained earning directly, because the basic principle is that over and above over the period of time, as it is going to get reversed when the employee will be paid gratuity or when they will leave. So it works on basically this principle, and if there is any actual gain or loss, I think all of you must be aware of this, because we are doing it for the other listed companies also. So it is to be routed through OCI, and this was one of the main reasons which affected the profit after tax of NBFCs. So Ankit, to give a brief background of the type of observations that we are discussing. So for all of you friends, these observations are from a CAG report which has been conducted in the previous year itself. So it was basically, they selected few of the NBFCs based on like housing banks or proper NBFCs, and they have figured out various accounting standards, and they have published a report as to what was the impact of implication of accounting standards. So see, from the banking perspective, when we meet or deliberate before the banking companies, there is a very common question that whether it is going to affect my profits. Everybody talks about, provisioning, because when you will shift from IRAC norms to ECL, it is certainly going to increase your provisionings. That is for sure, and it is going to affect your profits. And Ankit, as we were discussing last week, that in the statement of SBI's chairman, he has mentioned while publishing the Q4 result that SBI per se is, pretty much ready for application of any, new ECL provisioning framework or index, because they are adequately provided for the bad loans or any sort of provision which is required to be done. So when we talk about this particular measurement of investments and assets at fair value, so Ankit, I would like to add one thing in this, as you mentioned, that the whole concept of index is based on fair value measurement, whereas it was not there in the present accounting framework which was applicable on the banking sector. When you see, foreign banks, I was reading a report from the Central Bank of European Union, in which they have, mentioned that they have few, apprehensions while following these guidelines. One is the basic apprehension that we have seen in the last week also when we were deliberating before the board of a bank, that the prudence norms, because when you if you read Indian accounting standards, literally they mean that you need to recognize income on even a non-performing asset also. When we see the IRAC norms, it says that all unrealized interest is to be reversed, and you are not required to recognize any sort of income or on NPA assets. The second point here is that while we discuss effective interest rate or amortization, it is basically, Ankit, it depends upon two factors. One is when you see about fair value measurement or passing it through profit and loss or other comprehensive income, there is a test called SPPI that is solely for the purpose of principal and interest. So basically, all of the friends who are from the banking sector are aware that there are 2 or 3 type of securities. One is held till maturity, HTM. Other is held for sale, and third is available for sale. So when we talk about held till maturity, in that case, the valuation is to be done on amortized cost method, and when you talk about held for sale, then it is to be done on fair value basis. So this is a fair bit of overview of what is coming in front of us, maybe after 2 years or maybe after 3 years. Over to you, Ankit.
So I think very well, well explained and explained in detail. And similar kind of impacts we are trying to figure out when we look at the deferred taxes. We see new timing differences coming because of the measurement or the carrying value of the carrying amount of the assets or liabilities in the balance sheet. So this was not previously required as per the accounting standard AS. But with Ind AS coming, this would either increase the profit or decrease the profit. The third is the measurement of investment and assets at fair value through P&L account, and all financial assets and financial liabilities which were carried at cost as per AS. In Ind AS, they shall be initially recognized. Financial assets shall be initially recognized at fair value, and then eventually be amortized by a plus rate method. So this will also increase or decrease the profit in totality when we start measuring our investments. We go on the next slide. So next is the provision of impairment allowance and bad and doubtful debts. Again, the method we were discussing, the expected credit loss method, and this comes here that the provision for impairment of loans to customers was earlier made as per the IRAC norms or the guidelines. Now with Ind AS 109 coming up, impairing a financial asset needs to be taken based on the expected credit loss method. So this may also increase or decrease the profit. We are trying to highlight those areas which, as a banking company, you should start working about, since we are almost on the verge and almost, as you know, we are already filing half-yearly statement in compliance with Ind AS. So all these things, I am sure we are able to account the impacts well in time. The next is a important point. Kuldeep ji, you would want to take this upfront fees
Yeah.
and
Yep, sure, Ankit. So this was a very, very interesting observation or a very interesting impact which is going to take place when the banking companies will follow Ind AS. It is regarding to the upfront fees which they charge on loans. So basically, what happens is in the present accounting framework, there are three steps of granting a loan. One is sanctioning, another is dispersal. So basically what we see is in maximum of the banks that the processing fee or any charges related to sanctioning of loan is being debited at the time of dispersal itself, and say the whole amount ₹100 is credited on a bank account in the bank of the borrower, and the per se 10% or 10 rupees is the processing fees, it is being debited, or the other side 90 rupees is being credited to the account of the borrower after deducting the upfront fees or the processing fees. So what we were doing till now, as per the Indian as per the accounting standards, is that we were booking that processing fees as income in a financial statement. But when the Ind AS will be made applicable, and if the banks continue to follow the same process, then in that case, that specific part of that upfront fees which is being charged at the time of dispersal will be treated as part of that financial asset, and it has to be included in the initial recognition amount. So this is, Ankit, this is going to be a very big change, the way the banks or the banking companies account for these type of incomes, and it is important from the
I
perspective
think
of
it is
accounting.
not only it is very controversial also. So how
Controversial.
do bank account that? How do they,
Mm.
because when they are doing this, when they are recognizing this piece as a part of this at the time of disbursing the loan. So that means there has to be two separate practices which
Mm.
needs to come up. A
Mm.
practice about recognizing the upfront fee and a practice about disbursing the loan and not correlating it with it.
Yes.
Because I don't think banks have this possibility of taking this upfront fee before disbursement. I don't think that it would be. So how this change will be accounted, it will be very interesting. I think interesting to see this entire paradigm shift. We go on the other portion. So this is what we were discussing while Kuldeep ji was talking about the report. Another is the divergence in the asset classification provision. And again, as previously also some of the audience asked what kind of commonly found errors. We realize this fact that a disclosure needs to be made if an asset is in there's a divergence in asset where a provisioning of more than 10% is found more than published profits, then also a separate disclosure is to be made. Where additional gross NPAs identified by RBA exceeds 15% to your published incremental gross NPAs, then in such case also disclosure to the notes of accounts and financial statements needs to be made. So again, a commonly found error on which RBI as an external body issued an advisory. If this is there, then uh, if there is a divergence in the asset classification norms exceeding 10% and 15%, then a separate disclosure needs to be given as a part to notes to accounts. Kuldeep ji, do we have any questions still here?
Not yet, but I would like to take up the question of Mr. Sharif from Federal Bank that he has asked in the beginning, whether the Gift City branch, how the Gift City branch be considered operating in India or outside India for geographical segmentation. So, Mohammed Sharif ji, to be very specific, when you go through the circular of RBI, which was issued in May, I guess May 2019. It was regarding that GIFT City only. It states that for all very purposes or for all sort of evaluation of applicability of banking regulations or other laws, any branch or any bank which has set up a branch in the GIFT City will be treated as a branch situated in India only. So there is no specific mention which is being given in the accounting standards also. But I think it is very clear from this particular clarification or guideline of RBI that if there is any branch which is situated in the GIFT City, though it is because the question arises here is that IFSC has some sort of relaxation or different regulations from the normal banking environment, but it is treated as IFSC. So in our opinion, from the clarification which RBI has given, any branch which is situated in the GIFT City will be treated as situated in India for the purpose of geographical segmentation.
Correct. Okay. So now I have, do we have any questions still here? Otherwise, I have a question. And we are coming towards the end of the session. So we will talk about, what kind of evolution we see in annual reports, along with, as our chairman research committee said about, coming up with the HDFC report. I just downloaded it, and we will try that. We look it from integrated reporting framework. Kuliji.
There is a question, but I'm not sure what it is, from Mohit from Jaipur. RBI come out with updated circular with updated limits. I don't know what he is referring to, but Mohit, from accounting perspective, if I'm not wrong, the master circular dated 30th August 2021 is the latest one in which RBI have published the draft of the format of the financial statement, as well as clarified on various topics such as accounting standards, and the one that Ankit have taken in the previous slide related to divergence in provisioning. The provision was there before also, but there was a slight change when related to the profit. The criteria was 15% previously, now it is 10%. That is the basic change if you are talking about this circular.
Okay. So now we move on the next part, and when we look about the next part, I have a question to my learned audience who are into the corporate teams of their bank, or who are even on the auditor side. What change do you see in 10 years, last 10 years, say an HDFC or an Axis Bank report in 2013, or HDFC, Axis Bank, or any public bank's report in 2023? What are those significant changes? My idea to come up with these significant changes is, if some of the banks, and especially the public sector banks, are not able to cope up to that change, so we are trying to highlight the areas on which we should start working for a better corporate report, for a better annual report. So can we have some answers here? I am expecting an answer in last 10 years. What are the most prominent changes as a user of an annual report, as a preparer of an annual report you see?
Not related to this, but what I mentioned, Mohit has replied on divergence limit. Mohit, I think we have already covered the same.
Okay. Any answers pertaining to this?
Not yet, but I think, friends, this is a very interesting and important part of the session that we are going to start with, and we expect at least few answers on this particular topic.
Absolutely.
Because
this is non-technical. Isse pehle we were discussing, say, test applicability or FRRB's report, right? So since we have all kind of audience, and there might be some users of these annual reports also here, because a key agenda of this session is also how do you read an annual report, or what kind of interpretations you derive. My point here is, what changes do we see in last 10 years? A HDFC report which was prepared in 2023 to an HDFC report in 2013. Do you see any significant changes?
There was an answer from Mr. Mahadevan Ji from the Federal Bank. He has mentioned BRSR.
Right, sir. So one is the BRSR, but I'll come up with other points also. So be it the first change which I see is the visual aids. And as we were discussing, what makes your report an excellent report, and I mentioned it previously also, it is the visual aids, the interactiveness, the way you are interacting with, your stakeholders. Kuldeep ji, I would want to give you example of future generally, and since uh, we were working for them. So in that particular case, we realized that they came up with a theme-based report, and last year they came up with a report of on a theme of Bollywood. So when you see that, maybe it is too much of interactivity. You may download the copy of Future Generally last year report. It would be one of the most interesting report. So sometimes because the financial numbers, because with so much of data, it appears to be boring to interpret or read an annual report, but it is companies intent that how they are able to pull their interest of their stakeholders, right? So from that point of view, I think it is an ideal report. Don't go on that kind of evolution that a Bollywood theme, or to this time they're coming up with an IPL theme. So you can choose certain themes and you can use more visual aids. Rather, Kuldeep ji, Future Generally sold more than 3,900 copies on Amazon of their annual report. So that is one kind of a change. So one, it is mandatory. Yes, it is mandatory to publish it, but how much you are able to entice your stakeholder is something which comes out of this slide. The other important thing is, as I told you, there are multiple sections coming up, and the reputation, a director's experience is given in corporate governance report, also in director's report, also in corporate overview also. So how do we cross reference it? One, two, it should be easy to navigate. We see a commonly found, and there is a mark attached in institute's report, if whether your report is easy to navigate or not. So all these things. Then the answer which came from Madhavanji, I completely agree. This BRSR has shifted the entire practice of financial reporting on sustainability reporting. Rather, Kuldeep ji, I was with head of corporate reporting of Reliance in last week, and he spoke to me that he was looking after the financial reporting part, but in last 1.5 years, sustainability has taken everything. So that is for sure. And then how do you focus on your ESG targets? Another important thing which we realize, and which banking companies specifically don't realize, is the value of enhanced disclosure. So there might not be too many gaps into it, but when we talk about excellent reporting practice, then you have to move one step ahead, enhancing your disclosure in compliance with accounting standard. Naturally, with Yes Bank, as Anuj was saying, or what PNB, what we saw in PNB, a lot of emphasis is given on increasing the transparency of the report also. 10 years back, the reports were not that kind of transparent, were not that kind of interactive. And then the last is the integrated reporting framework. And I think, Kuldeep, since we are left with last 5-6 minutes of the session, I would just want to, touch upon a few things. We have highlighted, commonly found errors here also, but my point here will be, let's look into the integrated report of HDFC. Maybe that then we comply to Anujji's message also. So my question to my participants here: what is an integrated reporting framework? One, two. Can you tell me those 6 important capitals of integrated reporting framework? And is integrated reporting framework, is our banking companies adopting integrated reporting framework? So I have 3 questions. One, what is integrated reporting? This is an optional answer. I am sure everybody here would know this basic answer. I want to know the capitals, the 6 important capitals, and then we come on how do we disclose these capitals in our corporate reporting, because Kuldeep ji, maximum companies are disclosing it in a very subjective way. It has to come out objectively. So again, raising my question to my learned audience, can you tell me those 6 important capitals of integrated reporting? Kuldeep ji, waiting for answers.
I am also waiting for the answer. There was a message from Kirti Shukla, not the answer, that kindly share the presentation at the end of session. It will be very helpful.
Surely, we will ask Neha to share this presentation. But I am still looking at the answers. In meantime, I'm opening the HDFC report, Kuldeep ji. By the
Sure.
time we get those answers, right? So Kuldeep ji, I'm coming on HDFC reports. Do we have?
I think we
do we
should
have any? Because we
not.
are running short of time. So I'll straight away take you to the integrated reporting framework. And here it comes, right? So an integrated reporting framework is in compliance with IIRC, as I told you previously. It has 6 important capitals. I hope you are able to see those 6 important capitals. The financial capital. So now it's an entire value creation model where materiality assessment also needs to be done, where it is aligns with the sustainability goals also. So you look at this entire report. I hope it is visible. Should I zoom it, Kuldeep ji?
A little bit, I would suggest, because it will be easier for the viewers to see.
Okay, I'll try. Okay, because then we don't see the entire value creation model on one page. So in this one, all the companies are adopting integrated reporting framework. They have to understand the fact that the first thing is you have to introduce your capitals. The second thing is you have to KPI, you have to benchmark their KPIs and KIAs. Then the third thing is how you are creating this value addition model. This is the crux of integrated reporting framework. When we look at HDFC's integrated reporting framework, we realize that they have. I was asking this question. I still did not got the answer. We have deliberated an integrated reporting framework is so much discussed and very surprised that there were no answers. But let's go and start deliberating it further. So you see the first capital, and the first capital is the financial capital. And when you look at, now you are classifying each of your accounting parameters into each capital as an input. When we say our resources, we are saying this is our input of each capital. When you look at the shareholders value creation, this is our, KPIs, KIAs, key performance areas, our value creation process, and then the outputs. So each capital needs to be benchmarked based on the input and output. And if we are able to show the, the growth into each kind of capital, then I think that could be a perfect idea. Important, this entire value creation process is a part of this integrated reporting framework. First, you need to make your stakeholder understand what all these 6 capitals are. Then you come on this model. So when you look at financial capital from a banking point of view, a financial capital is its deposits, it's its shareholders' funds, it is external borrowing, anything, even you can take your reserves into it. So there is no harm taking your reserves into your financial capital. They all are sources for your operations. You added the value. This value creation chart could be different for every bank. And then the outcomes. So the outcome, you look at EBITDAs, you look at profit margins, you look at cost of income ratio, the return of capital, the return on asset. All these things are the output of your financial capital. This is a subjective thing. IIRC doesn't provide that, all these things should be considered as a part of financial capital. Again, I'm repeating, whatever you are sourcing and whatever output you are delivering, if it is a part to your financial capital, if it falls in the definition of your financial capital, needs to be disclosed. The problem commonly found error, Kuldeep ji, I find there is people don't disclose the numbers. Especially not on financial capital, but say your human capital, but say your intellectual capital. So intellectual capital, say for example, Kuldeep ji, when we look at all these 6 capitals, so first is the financial, second is the human, third is the social and relationship capital, fourth is your manufacturing capital, fifth is your intellectual capital, sixth is your natural capital. For banks, I would say I'll discuss two capitals and then we end up with this session. One is the intellectual capital. So see, even HDFC has not appropriately disclosed. The output is just not the brand valuation which you have done, but the quantum of IP you created. So can you quantify your trademarks? Can you quantify your copyright? Can you quantify your know-how? Can you quantify those IPs in value is what we are looking at it, right? So naturally, please, my request here will be any subjective answer, any subjective outcome is not what integrated reporting framework expects you to do that. Similarly, for a manufacturing operation, how many outlets we are able to create, how many number of branches we are able to, add in this year, the quantum of ATMs we are able to open, the coverage of towns. So for every banking company, this could be entirely different. Now, my request here to all the audience here is, this is a forward-looking framework. As of now, you can voluntarily adopt, but those who are looking for this excellence in financial reporting award should come up with integrated reporting framework, because it has a due weightage, especially when you are a listed bank and you fall in the category of top 500 banks, sorry, not top 500 listed companies of the country. So one thing, Kuldeep ji, I hope we are able to solve a doubt. In case you have any questions, please let us know. Else we start, we give a conclusion to this entire session. Kuldeep ji, do we have any questions?
Not yet, Ankit ji. No questions as of now. But I would like to add one thing to this particular, integrated reporting thing. Once you, though it is not compulsory for you to, follow the integrated reporting approach, but once you follow for a year, then it becomes compulsory for you to follow in the coming years. And as Ankit ji, you have rightly mentioned and very well described about the capitals that a particular bank or a company need to, specify while preparing the integrated report in letter and spirit. But as we see in this particular report also, the outcomes or the inputs are not, perfectly meshed. Both has to be quantified. So they've quantified the outcomes or the outputs, but the inputs in some cases and outputs in some cases remains unquantified and unspecified. Over to you, Ankit ji.
Kuldeep ji, if any questions, else I think we start. I'll just put up a concluding remark. This award, as Anuj ji told, is a very old award. It has a history of 65, 68 years. I and Kuldeep ji has very closely witnessed from institute receiving a nomination of 10, 15, 20 corporates, and then eventually, selecting few of them. Institute evolved very well. The research committee evolved very well. And last year, Kuldeep ji, we had more than 260 nominations, which were the highest. And in banking category only, we had 18 nominations. This year, we expect 400, 450 nominations. And we expect a lot of bankers' participation into it. The problem is that a lot of people pay trust only on one section of the report. Since now we have Neha monitors this very closely, she is also here. It is just not about the financial statement or balance sheet or profit and loss account which we are submitting. It is on each segment which we have to work, each segment which we have to qualitatively enhance. Each disclosure needs to be reworked. Let change that practice of copy pasting your previous year's annual report. We need to start customizing it to the current year practice of your banks, and how are you highlighting the material changes. So my request here will be, I think Neha and team have taken a great effort in building this entire concept, and a great competition, a healthy competition, and we see a lot more companies coming up. But as chartered accountants, we are in industry, we are in practice, we need to gear up ourselves. We need to start strengthening our systems of corporate reporting. Lot of companies fail in that fashion, wherein when the last quarter board meeting is done, they give up. The best part comes now, because the ultimate document which reaches to your stakeholder is this report. All your audit fees, all your accounting, expense which you are, which you are making, is eventually for this one document. This one document holds a lot of importance. Please don't take it complacently. That would be my humble request. Please work on all sections. And now over to Kuldeep. Thank you so much for patiently listening. Thank you, Neha, for wonderfully coordinating and helping us out. Over to Kuldeep ji.
Ankit ji, before we conclude, there is a question from Mr. Mahadevan from Federal Bank. So I think we can take out 2-3 minutes and we move on to the integrated report on SDFC. He is asking that please explain social and relationship capital.
Okay, I'll just open up. Is it visible?
Visible. Page number 17.
So when you zoom in, Mahadevan, I think okay. So we have, as the name suggests, right? When we say social, so we relate it to corporate social responsibility. We relate it to the social commitments what bank is able to create. As a bank, it has a lot of, as a banker, it has a lot of, bank has a lot of responsibility to create social impact, because as you know, when we were beginning the session also, there's a lot of, in case India has to reach to a number of 5 trillion or whatever, right? The bigger numbers, banks have a very vital role to play, not only in terms of numbers, but the quantum of impact they are able to create. So when you look at this entire social and relationship capital, you realize your CSR expenditure is one thing, right? When we say CSR, it is social. When we say relationships, then we are saying how many partners, how many DSAs, how many agents, how many merchants, right? How many partnerships with government. So wherever you are able to quantify a relationship, so it is also not a correct disclosure, I would say. You have much more relationship capital. So that relationship capital has to be exhaustively disclosed. And when you look at the output side of it, right? So yes, number of customers added is something which we should come up year on year. We can also come up with total number of customers, the net promoter score of the organization. I would also come up with, when we are saying social, it is just the impact which we are able to create on society. For example, if HDFC sponsored say 100 or 1000, some water coolers or something like that, these numbers can also come up. So, if they've undertaken a village for upliftment of the education, if you are coming up with a banking institution, school, college, all these things could be quantified in much better way. But yes, it is just not only about the quantum of CSR spent. You have to come up with more specific points as to what kind of impact we are able to create in society. I hope I am able to answer it slightly. Again, I would say they must have also defined what is their social and relationship capital. I'll try to find out if and you might also find it in the report. Kuldeep ji, if you want to add something into it, else.
I just wanted to add one thing, that while we talk about any of the capital, so to be specific about social relationship capital, it is not looking at the amount of expenditure that we are doing in CSR. It is holistically looking at a bigger picture, that how we are affecting and how we are improving the lives or the quality of lives through the initiative that has been taken, as well as how the bank per se is creating a value for the DSAs or the merchant partners. So there is a lot you rightly mentioned, which is to be described, and they have described also.
Ji, I have just opened this page
Hmm.
when they introduced their social capital.
Hmm.
Now everyone introduces it well, defines it well. They have defined it very well. The rural development, the education program, skill institutes, financial literacy, and the kind of change they are able to make into it. But when they come on creation of this value adding process, you will see it is not in sync with
Hmm.
what we have defined as a goal. So that is a common problem which I realized. I hope Madhavanji, you got your answer. And anything else? Any other question, Kuldeep ji?
No, not yet. So I think we can
So
conclude.
I think now you concluded. I have already concluded it.
Uh, as we always say that there is a very thin line of difference between reporting at par and reporting above excellence or reporting above par. So it is good to be in competition, and it is good to be compliant with the applicable laws and regulations, but there is always a little bit more that we can do while we talk about enhancing the disclosure. So I thank you whole research committee, and specifically Nehaji, you for coordinating and making it an easy task for both of us. Over to you, Nehaji.
Thank you, Kuldeep sir. Thank you, Ankit sir, for such a wonderful session. And I think it is a great knowledge for everybody, as you can see from the number of answers that we are getting and the participation and the response that we are receiving from all the participants. So thank you so much for the wonderful session. And I would also like to tell to all the participants that the next session of this series, that is the fourth session, it is scheduled on 9th June, and which will pertain to the insurance sector specific. So with this, I think we can conclude with the session.
Thank you, Neha. Thank you, everyone.
Thank you, everyone.
Thank you.